Hello everybody, welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Virus Turns the Housing Market. We know it's happening right now, it's big time, and things are changing every day, and we're getting a lot more information of how this is going to all play out. I'm Randy Patrick, your host, putting the realism back in real estate. Today is April the 15th. It's actually, tax day? But no, it's not tax day. Tax day got moved 3 months ahead to, I think, July 15th. So those of you who haven't filed yet or who can't file, you've got a little bit of a reprieve. I still believe the extension is still in effect till, I think it's October 15th anyway, the 6 months extension. But you got a bit of time now because obviously people are having a hard time getting stuff together, which I can fully understand. And today we're really going to get into it. I think the number one news factor here is we're starting to see numbers come through now. Now we're seeing real numbers that are happening, so we're lagging in the information, but it's it's timely within a week or two of what's happening with unemployment and forbearance. And then now we see a lot of people who are trying to project the future number of delinquencies and stuff like that. So this is kind of where we, as we'll call it, either real estate investors, buyers, agents, whatever you are, your interest in real estate, whatever turns your crank into stuff. It's how can we project the future market and figure what to do. That's the number one thing out here. So basically, I just want to sort of talk about this today. I think today's a numbers day again. Nearly 2 million struggling homeowners apply for assistance as forbearance explosion paints a dire picture. So, by the way, if you're not already a subscriber, please help my channel grow and click the subscribe button, bottom right of the video here. Thank you. So, this is the scoop here. 2 million people have filed for forbearance so far, which is interesting because today, as I said, is April the 15th. So, when you take a look at your mortgage statement, typically, all mortgages are due April the 1st, and then you have basically up until like the 15th or the 16th to pay. Anything past the 16th, you actually have to pay a late fee on your mortgage. Anything past the end of the month, now you roll into a 30-day delinquency is where you're at. So as of April the 15th, or actually, this was probably last week, I'm sure this is probably the week before, nearly 2 million struggling homeowners applied for forbearance assistance. So that's not even, the first half of the month's not already here, and we already have 2 million people who have jumped in on this. So I guess that's kind of where we're going to be. Basically, for context, the total number of loans in forbearance was just 0.25% for the week of March 2nd. So we've had basically an increase of almost 1,500% in just 6 weeks. So borrowers top in forbearance now topping 2 million according to CNBC. Of the increase, the borrowers with Ginnie Mae loans are the worst shape, jumping from 4.31% to almost 6% of forbearance requests for Ginnie Mae loans. And a lot of the non-banks, shadow bank industry like Caliber Home Loans, Carrington, PennyMac, Quicken Loans, those are all non-banks. So they're underwritten by Ginnie Mae, and that's where we have the potential liquidity crisis right there. So 6% of those loans are already in the forbearance process here. The Mortgage Bankers Association, I guess the chief economist basically said, with mitigation efforts seemingly in place for at least several more weeks, job losses will continue and the number of borrowers asking for forbearance will likely continue to rise at a rapid pace. So this is just the first couple of weeks. We're going to see a lot more of this going on in the next little while. So there you go. Now this came out today or yesterday. The second wave of coronavirus layoffs claiming workers who thought they were safe. So as of my one of my videos last week or the week before, it was within a 3-week period, nearly 17 million people had filed for unemployment. So you have people who filed for unemployment. You have people who probably haven't as of yet that could increase the numbers. Initial victims of the lockdown were the most financially vulnerable: restaurant workers, retail employees, other low-paying jobs and industries which were immediately impacted by lack of foot traffic or shutdowns. Now, a second wave of layoffs is hitting those that thought they were safe. According to the Wall Street Journal, white-collar workers working from home are being laid off by companies suffering from dismal sales. Law firms are cutting hours, eliminating positions as court systems and legal actions have ground to a near standstill. And government who assumed their jobs would be safe, government employees who assumed their jobs would be safe are being furloughed amid city and state budget shortfalls. Even healthcare workers who aren't directly fighting the pandemic are finding themselves without work. So lots of change happening. So again, it's the most vulnerable or the sort of obvious stuff gets hit first. Now we're going to see second and third waves of more stable employment, maybe, and also higher paying employment, where they're getting laid off, reducing hours, or just completely losing their jobs. So that's kind of the scene here. Now, what's going on is people trying to predict where we're going to end up, as I mentioned. And according to the Wall Street Journal, the consensus of 57 economists surveyed this month by the Wall Street Journal is that 14.4 million jobs will be lost in the coming months, and the unemployment rate will rise to a record 13% in June. 17 million Americans have sought unemployment benefits in the past 3 weeks, dwarfing any period of mass layoffs recorded since World War II. A chief U.S. economist of Oxford Economics predicts almost 28 million jobs will be lost, and industries beyond those ordered to close will account for 8 to 10 million. They're looking at just a lot. Basically, we're talking about service workers, lawyers, architects, consultants, advertising professionals, as well as 1.5 million non-essential healthcare workers, 100,000 information workers, including those working in the media and telecommunications. So really, the virus shock does not discriminate across sectors that we initially thought. So this is going to be larger than we actually think. And I guess when you take a look at, for me, when you take a look at people talking about a V-shaped recovery, I've seen a lot of videos and a lot of people writing about that going, typically the harder and faster we fall, the bigger or quicker the rebound. Well, it's almost like we're falling really hard, but the recovery is going to take longer, and it's going to be more of a elongated U as opposed to a V-shaped recovery here. So please keep that in mind. Supporting this, this analyst was talking about Walt Disney World. So I live in Tampa, Florida, and Disney World is about an hour and a bit east from us, all along I-4, Highway I-4. Basically saying it could be years before Walt Disney World Resort returns to normal operations. A securities analyst for Wells Fargo told the TV station Orlando. Theme parks have all been closed since mid-March with no open date in sight. And the security analyst says he expects no attendance for the rest of the fiscal year, and parks working at 50% capacity in fiscal 2021. So until the time at which there is significantly improved testing and or widely available vaccines, tough for us to imagine long lines, no matter how much folks want to go to Walt Disney World deep down. Disney almost never closes, says it could also experience revenue loss from its hotels, as well as the fact that no cruises will be setting sail for a while. And this is just an example of a location. So if you pick Orlando, so you have, again, I'm just using this as a perfect example here of how this could affect the domino effect for housing. Well, Disney dominates Orlando. You've got SeaWorld, you've got SeaWorld and Islands of Adventure, you've got theme park, like water theme parks, you've got Universal Studios there, you've got all sorts of other smaller attractions, you know what I mean? Like, I forget, like the one where you basically are watching the nights and everything, and you're having your meal and you're eating with your hands, like all those things like that. All that's going to suffer, all right? All the hotels that are in Walt Disney World, all the restaurants that, ever been to Orlando, there's something called International Drive. It's basically hotels, attractions, restaurants, and shops. I'm assuming that whole place is probably a ghost town. And that's just, that part of, of the area. You've got other locations that have, there's a lot of, we'll call it, condo hotel type things that support timeshares and all these type of things that go on there. I mean, I'm driving down International Drive. I see you got helicopter rides. You've got, small little amusement parks. You've got all the, t-shirt shops and the surf shops and things like that. So if you take a look at how this can affect a location, this could be devastating. And, one might argue saying, well, most of the workers, are going to be, probably renters anyway. Well, you never know, but that still, if they are renters, and the multifamily units are going to suffer, and the people who actually have, I know a lot of people own property, and rent it in Orlando. So there's no tourism going on, there's no Airbnb going on, and any sort of long, short-term rental is going to get creamed basically. So again, I look at this going no V-shaped recovery here. Now this is Orlando, okay? This could be different for a different city across the U.S. So I think, each metro is going to have its own nuances of how it'll be affected, what the damage is going to be, and how the recovery is going to take place. So talking about mortgage forbearance, basically that's the word this week, forbearance and delinquencies. Mortgage forbearance is suddenly hot, hits the shadow banks, which clamor for bailout from taxpayers and the Fed. So really the mortgage market has more risk than previously acknowledged. One of the things that I've said for quite some time now with respect to the housing bubble as it's been growing over the past couple of years is the fact that our demographic of buyer has slowly been changing, or maybe not the demographic, but how that buyer is actually buying. That's been changing. So we have seen the sort of the surge of non-banks, so which is the shadow banks, okay, the non-banks, and we've seen a lot of those shadow banks who are offering, we'll call it Ginnie Mae backed mortgages to the stated income people. You've got FHA and Fannie and Freddie backed mortgages for some others as well too, and 3% down, 3.5% down, high debt to income ratio, all those type of things. Now, the people who I guess you could say don't agree with what I'm saying, or other analysts, they're talking about QM. Well, we have qualified mortgages. That's why we won't have another housing crisis. Well, guess what? There needs to be an event that sort of, we'll call it, shocks the housing market. This is the event. It's going to get worse before it gets better for sure. And these are the people. If you bought last year at the relative peak, in a major city with 3.5% down, and you had a high debt to income ratio, and maybe you've lost your job. Maybe it took two of you and your income to qualify, and somebody's lost their job, so now you only got one income. So these are the things that can happen. Oh, well, I need to sell my property. Well, guess what? You put 3.5% down, and with basic real estate closing costs and commissions, you're already underwater. Okay, and I can tell you right now that we can take a look at homes being delisted, homes coming on with a less price, and people not just, and right now as a result of what's happened, you have lenders that are not lending, or I guess they've halted their lending operations to see how this plays out. So you want to sell your home, you got to reduce your price, but now the buyer pool can't get financed, and look what's going to happen. So we're entering into this kind of this crisis crash point starting, and yes, it's a little different than the last time around, but again, we've built it to a point, and now the things are going to crumble, and it's just the nature of how we as a society, we as a government, we as Wall Street, whatever you want to put the blame on it, has allowed this to balloon up to a certain point, and now they'll just take advantage of it. Simple as that. So just keep that in mind. But for the next little while, all we're going to hear about is forbearance, unemployment, and basically the mortgage market has more risk than previously acknowledged, said the American Enterprise Institute, which among other things covers the housing market and housing policy. Basically was particularly pointing to how at the FHA's large book of high-risk, low down payment loans, lending targeted to first-time buyers, investor loans, and refinance loans. So really it's, they're trying to reap the rewards of the gravy, but this is with the higher risk, demographic of buyers, profiles with respect to type of loan, investor loans, or whatever, okay? The federal government's dominance in the undercapitalized U.S. housing finance system means many of these stresses will land on Treasury, Ginnie, the Fed, and FHFA's doorstep. So please keep this in mind. This is just not me saying this. This is a lot of people. That's from the American Enterprise Institute, which I think is based at Harvard University. And they're basically, I talked about this last video, is that they're saying we're going to see a lot of damage in the coming months here. So don't be surprised. And we warned you. All right, unemployment could lead to mortgage forbearance surge. Back to the numbers game when everyone's trying to predict how many delinquencies we're going to have. Well, Black Knight Financial estimates that an unemployment rate of 15%, as projected by Goldman Sachs for Q2 2020, could result in 3.5 million new mortgage delinquencies. So I can tell you that 3.5 million new mortgage delinquencies, not every one of those will be applicable or receive or will get the forbearance offering, all right? Which means they're going to go into the system, they're going to go through foreclosure, and they're going to have some problems at the end, and that's how the market's going to sort of play out. So just, and again, they're predicting about, if unemployment rises more, how many more delinquencies we're going to have, etc. So I think it's a little too early now because, listen, we're not even through month one yet. Here we are, it's halfway through April, 2 million forbearance requests plus and growing, and everyone's just trying to put their spin on it. And I do think that people are being conservative. I mean, you're trying to extrapolate what's come out so far. It's one of those things we don't know how deep this is going to go, but this is what we talk about all the time. Economic uncertainty impacting the housing market. Again, another article about this, talking about how the cost for the servicers here, and the reason why, and then funny enough, so sometimes you might see that a lot of these guys aren't the non-bank shadow banking have sort of slowed down or even halted some of their lending. And the reason being because if the economy is jittery and the investment market is spooked, if they take on a loan that's, say, not a traditional qualified mortgage loan, they have to sell those loans on the open market, and the investors aren't feeling comfortable to purchase those loans. So therefore, if they can't sell it, they can't finance it over long term, and therefore that's why they're not actually offering these loans anymore. So we're going to see how that plays out with these non-banks, these shadow banking things. But again, after home affordability improved to its strongest level in more than 3 years, recent jumps in 30-year rates falling below record lows in early March have significantly shifted the affordability landscape. And now we're saying as the buying power of a prospective home buyer, basically, I guess you could say, who qualified for a $1,000 per month mortgage with a 20% down payment rose from $270,000 at the start of the year to $292,000 on March 2nd when the rates were at its lowest. Okay, so basically, when the rates popped up again, because so the rates have gone up a little bit apparently, just to stop the mortgage, production, that same borrower would have only qualified for a $258,000 home purchase, a $34,000 reduction in home buying power. So really, it's kind of like the rates are going to dictate what people will do, and if the rates rise, it'll take the wind out of their sails. They're not going to buy, or they can't afford to buy as much. The buying power is gone, which also will sort of slow down buying too. And again, it's not the whole thing here is designed to, we'll call it mitigate mortgage exposure for the lenders here. Mortgages in forbearance increased to more than 3%. Survey from the Mortgage Bankers Association basically said the number of loans in forbearance rose from 2.73% to 3.74% during the week of March 30th to April 5th. So really going up a point, March in 1 week is pretty significant. And remember that as of March the 2nd, just 0.25% of all loans were in forbearance. So we're going to see, again, 2 million so far. As a percentage, you may go, what's 3%, what's 4%? It's not much, but when you extrapolate those numbers, it represents over 2 million people in forbearance. That's going to grow, and the numbers are going to get bigger and bigger. All right, delinquencies could jump significantly with rising unemployment, of course. Now, CoreLogic put out their loan performance insight report, and basically same thing. They're just saying that they see a jump in some of the the pandemic delinquencies, and what else we got going on here? Everyone seems to be, I guess you could say, referencing Black Knight's financial 3.5 million mortgages that could fall in delinquency, shortly here. The top 10 states were rounded out for serious delinquencies: Maine, Maryland, New Jersey, Alabama, Arkansas, Connecticut, and Delaware. So that's what we got going on right now. Miami had the highest overall delinquency rate, whereas San Francisco had the lowest delinquency rate. And basically everything is kind of, right now it's like everything's holding. Obviously next month when they review April, we'll see where everything's gone. All right. This is interesting, and again, this goes back to, if you think about number of forbearance that's happening out there, you take a look at the more and more unemployment that's going to happen. 1/3 of Americans burdened by housing costs. So nearly 1/3 of Americans are burdened by housing costs, meaning that they spend more than 30% of their income on housing costs. The states most saturated with cost-burdened households are New York and California, according to analysis by Construction Coverage. In California, over 40% of households are housing cost burdened, and in New York, 37.5% are burdened. Now, among cities with more than 350,000 residents, Miami ranked number 1 for housing cost burdened households, and with 52% of them spending more than 30%. Miami was followed by LA, Long Beach, California, New Orleans, New York City, Anaheim, San Diego, Fresno, Oakland, Memphis, Tennessee, and Boston. So really, you take a look at, these are all larger cities, locations, much more expensive cities. So, except for Memphis, but other than that, everything else is pretty expensive. And again, I don't know how New Orleans plays out, but again, a lot of the California ones are pretty expensive. Ultimately, among mid-sized cities, Newark, New Jersey ranked number 1 for housing cost burdened households, followed by Hialeah, Florida. And the report also states that renter households are more likely to be housing cost burdened than homeowner households. About 46% of renter households in the nation are housing cost burdened, while 22.3% of owner households are housing cost burdened. So there you go. So ultimately, in the end, renters are going to have a hard time. If they stop paying rent, that's going to affect the people who actually hold the mortgages and financing, which are the landlords. So, there's only so far this can go before it permeates deeper and deeper into the housing market. All right. Now, so you want to go buy a house right now because you think opportunities are great. Now, one thing I do want to say, prices haven't dropped like immediately. So, the way the market works is like this stuff is happening right now. Forbearance is happening, unemployment's happening, more delinquencies are happening. So, but we're really in, we're not even over month one at this point in time as far as I'm concerned. Like really, it's kind of like as of April 1st, let's see how many renters stop paying. As of April 1st, let's see how many mortgagees stop paying. Like, so that we're going to see all this information middle of next month, middle of May, then we can determine a little better how things are going to play out here. But I can tell you that some of the banks, like the JP Morgan Chase, Wells Fargo, whatever, so JP Morgan scrambles to raise mortgage borrowing standards ahead of biggest wave of defaults in history. So you see, the analysts and economists are already saying that this is going to be massive. So this is not me personally, even though I do agree with them. These are people who are way smarter than me who are talking about this, and you can actually read the articles and get the proof on this. But, a JP Morgan, a Wells Fargo, B of A, they're all saying, well, we're going to raise our credit scores to 700 and 720. We're going to pull back, we're going to ask for 20% down. We're going to, not do jumbo loans anymore. We're going to, I guess you say, roll back on those. So, there's going to be some change here. So this is how the market gets hurt. So like the last housing crisis, so when the mortgage meltdown happened, subprime crisis, everybody doing cash out refis, when that kind of hit its peak and everything was falling apart, what did lenders do? Lenders didn't want to write loans at all because nobody wanted to be the underwriter who wrote and approved that loan that went into foreclosure shortly thereafter. So everybody got scared. So when stuff like this happens, the general, I guess, the reaction is to tighten up standards. Okay. So, but the point here, I got 2 points I'm trying to make here. So number one, the banks like JP Morgan, Chase, and Wells and B of A, they're not writing, or they weren't writing that many, we'll call it marginal type loans anyway. That market was dominated, or is dominated, by the non-banks, the Quicken Loans, PennyMacs, like Caliber Home Loans, Carrington Mortgage, and these other non-banks. They're the ones that are writing the more riskier loans. So when, the comments were when JP Morgan says we're going to raise credit scores and stuff like that and increase our down payments, well, it's not a huge impact to the marketplace because their clients typically would be having this anyway. So that's the point they're trying to make here. So this is not much of a revelation. However, it's an indication that it's going to be tougher for buyers to become borrowers and to get financing. And if a lot of these non-banks and servicing companies do have liquidity issues, or in fact may fail and cause some problems, then the buyers will go, okay, well, I need to go over here and get approved for a mortgage. Oh, guess what? Now we can't meet those new standards that JP Morgan Chase has set for us. So therefore, what are we going to do? We're not going to buy. We're going to rent for a bit longer until the market changes and things open up. Now we know the market will change down the road. Lending will open up again because that's how the banks and lenders make money. They have to lend to make money. It will change. It's just a matter of when and what the damage is going to be along the way. I would look at, we're probably going to see a few bank failures here and there, and we'll probably see some absorption by the larger ones. They'll take over some of the small banks, and we'll see how this plays out. Talking to some mortgage brokers, a couple of weeks ago, nothing is being written. Now we've already heard that, okay, people, the lenders have some of the lenders have said, okay, we can maybe do a little bit of amending here, maybe do a little better in our verification of employment, and maybe raise our scores a little bit. So they're going to get back into lending. I mean, they don't want, they don't want to say no forever because, again, their livelihood, is based on this, on lending money. So we're going to see this will be a little bit difficult for buyers in the near term. We'll see how things play out over the next couple of months. But that's kind of the scoop for today. So really what it boils down to is 2 million plus forbearances right now. We were at 17 million, I guess you could say, unemployment applications that were filed, as of, whatever the last reporting. Analysts are predicting we're going to get up to 28 million of unemployment in the next, by, maybe May or June. So that's basically adding another 13 million more onto that. So, that's a lot going on, and it will affect the housing market. There's no other ways about it. Right now, this is the time that if you have the extra cash, that maybe you might be able to pick up a deal cheap, because homeowners or sellers who want to unload might be going, I need to cash out now before it gets really bad. And guess what? I'm going to lose my equity. So there's deals to be had. I mean, we are already in position where what I would be offering 3 weeks ago is not what I'm offering today for property. And there sometimes you can tell when people just want to get rid of it. And it's not like they have to sell, but they want to sell, or maybe they're cash hoarding. Or a lot of people are going, I'm going to sell what I have now, position myself for something different in the future. So what I'm dealing with is a lot of cash flowing properties, a lot of rental properties that are becoming available. So we're taking a look at that. So having just said that, if you'd like more information about what we're doing with respect to the off-market properties, please contact me. As far as what I think will be great opportunity next little while for short sales and foreclosures, please get in touch with me as well too. I've got training courses for that, so we're going to put a big emphasis on that in the next little while. I've already started to change my marketing up to homeowners to reflect the current scene of what's happening and how they're going to sort of mess around with the marketplace here. So that's a scoop on that. So thank you for the views, likes, the comments. Again, if you want to contact me, send me an email, give me your telephone number in there. I know I have talked to a lot of people over the past few days, and that's been good conversations. There are people I still have to get with, so do apologize. I was out already today doing some work at a property, doing some final work, and checking out a few more today. So the world doesn't stop. When you go see vacant houses, no one's there, so it's okay to check stuff out. So anyway, that's the scoop. Let's look forward to speaking with you guys in a couple of days. Thanks.